Many institutional investors invest in the real estate asset class partly through private equity real estate funds. NAREIT recently compared the returns produced by private equity real estate funds to those produced by publicly traded REITs. During the full business cycle from the early 1990s until a peak just a few years ago, private equity real estate funds produced returns averaging 7.7% net of fees for core funds investing in stabilized properties. A little bit higher for value-added funds, 8.6% per year, in part because value-added funds use a great deal more leverage. Opportunistic funds use greater leverage still, exposing investors to much greater risk, but returned net returns averaging 12.1% per year. Publicly traded REITs, though, produced much higher returns, averaging 13.4% per year over the same full cycle. What explains such a dramatic difference in returns between publicly traded REITs and private equity real estate funds? We believe that the biggest difference is actually the essential business model of private equity real estate funds versus publicly traded REITs. One aspect of that, for example, is the fact that private equity real estate funds are under pressure to put committed capital to work. After all, they're earning 2% management fee on committed capital, even if it is not invested. And that means that they are pressured to buy properties, even if it's a bad time in the market cycle to buy properties. Conversely, they're under pressure to sell properties either at the end of a fund's life or when investors want to get out of a fund, even if it's a poor time to sell properties. For example, at the peak of the market in 2006 and 2007, private equity real estate funds bought $49 billion net of properties, even though it was the highest point of the market and therefore a terrible time to buy properties. They had to buy those properties from somebody, and fortunately publicly traded REITs were willing to oblige. They sold about $86 billion worth of properties to those private equity real estate funds. That means that REITs were selling at the top of the market, whereas private equity funds were buying at the top of the market. Buy high and sell low is not a good formula for investment success, but it has provided a good formula for success. But buying low and selling high has provided a good formula for success for publicly traded REITs. There are other aspects of the REIT business model that seem to drive superior decision-making. Transparency and liquidity don't just benefit investors. They also impose discipline on REIT executives to produce the best investment decisions possible. As a result, even during bull markets, REITs still outperformed private equity real estate funds, even opportunistic funds which used tremendously more leverage than REITs did. So even during the bull market, REITs produced better investment decisions. There's more detail on this analysis comparing private equity and publicly traded REIT returns. For more detail on this analysis, please go to REIT.com.